Gold prices topped the $3,000 level for the first time ever last week, up more than 13% since the start of the year. Our next guest was talking about $3,000 gold at the end of last year, saying that he saw upside risk from firmer central bank purchases. Join us now with more on gold and oil prices, commodities in general. Also, the energy group after those airstrikes in Yemen this weekend. Daan Struyven, Goldman Sachs co-head of global commodities research. It's not everything in your complexes is headed higher, which is what you'd think if the dollar was weak or getting weaker. That would explain gold, but it wouldn't explain necessarily oil.
So I think the broader driver here is uncertainty and risks, downside risks to the U.S. and the global economic outlook. And that is pushing down some of the more pro-cyclical commodities closely tied to U.S. growth, such as oil, but it's supporting gold. We have seen very significant increases in investor demand for gold, and we're seeing very rapid buying from central banks for gold as well.
If tariffs were going to be really inflationary, then why are you seeing deflationary forces in commodities?
So I think across the commodity complex, you have pretty divergent moves.
Right, so it's not all the same.
Strength in gold, strength in copper.
Yeah.
Softness on the oil side. And I think the main driver here is that we are expecting somewhat higher inflation, not because of a boost to global aggregate demand. It's primarily because of tariffs, which you can think of.
Well, where should we be seeing that then in the commodity complex?
Well, I think what's really interesting is that commodities are front and center in tariff policy, and so investors who want to hedge themselves against tariff escalation, I think, could either go for gold.
But didn't you just tell me, Don, that commodities were weaker, except for gold and other things? So that's why aren't they sniffing out tariff inflation?
U.S.-based commodity prices, for instance, in the metal space, have risen on the back of expectations of tariffs. I think one key priority for the U.S. administration is to boost domestic availability of both energy and metals, and therefore commodities are key targets for tariffs. And so you're seeing upward pressure on U.S. prices, for instance, of copper. You're seeing upward pressure on gold, given all the uncertainty about the economic outlook. So it's very much an environment where you want to be selective in your commodity portfolio allocation.
All right. You would expect other commodities to rise, grains, et cetera, from lumber, I don't know, things from tariffs at this point. Where's the index itself, the CRB, in terms of, is it off its highs? Where is it?
Yeah, we're up modestly, but with a lot of divergence under the hood.
Under the hood. You have an objective for gold long term?
So our forecast base case for year end is $3,100 per troy ounce. But we think that the risks to this base case and to our 3,100, 3,300 range are skewed to the upside. We have seen, it's pretty remarkable, we have seen a rally despite a decline in speculative positioning. So positioning is a lot cleaner than before the rally. And the reason is that investors, ETF holdings, have jumped. They have added 100 tons of demand over the last month. And central bank buying continues to be very strong. In January, central bank buying was 7 times higher than the pre-2022 average. Central banks across the world are worried that the dollar and Treasury holdings may not be.
I was going to say, is it a concern about Treasury holdings, too, U.S. Treasury holdings?
Yeah, and what you're seeing right now is that several G7 countries are suggesting not only to freeze Russians' reserves, but actually also to seize them. And if you're learning that dollar reserves are offering bargaining power in those kind of international conflicts, in the context of discussions of a ceasefire, it probably reinforces the willingness of EM central bank managers to pile up on gold.
Is drill, baby, drill the reason oil prices are weak, or is it because of growth worries globally? And China was strong, wasn't it? Are they cooking the books to look strong for the tariff onslaught, or what?
If you plot oil prices year to date against what we call a U.S. growth factor, which basically tends to decline when yields go down and when equities go down, the correlation is very, very tight. So the main driver here of softness in oil prices is concerns about the U.S. growth outlook. We also think that some pricing in of a ceasefire and easing of Russian energy sanctions has also weighed on both oil and natural gas prices.
Dollar getting weaker? Is it going to get weaker, the dollar?
Or FX strategists.
You can't say? You got the poor FX strategist is going to get in trouble if they screw it up. Never mind. If you don't have an opinion, I don't care. You don't have an opinion.
Or FX strategists, have downgraded their dollar views, both because of the positive growth news from Europe, with Germany defense and fiscal spending, which, by the way, I think is another reason to be constructive on industrial metals demand. It's not only electrification. Okay. Finally, Europe is spending, and I think that's another reason to be constructive copper, to be constructive Ali.